Hello everyone, welcome to our harmonic price patterns webinar. Is Wednesday, oh no, it's Tuesday, what am I saying? Tuesday, 27th of September. So the end of the month is on Friday, remember, end of the month, end of the week. Very important for some, for price action. So a lot of closing positions, a lot of repositioning as well. So keep that in mind, but that's not relevant with our today's webinar. So yeah, today's all about harmonic patterns. I'm gonna upload the handout just now. Give me a second. Where's my handout? Handout. Come on. Here it is. So you will have the handouts shortly. It's in the handout section. Yeah, and I'm good to start. I would really appreciate feedback in regards to the audio and the screen until I go through the disclaimer warning. So this material is provided as a general marketing communication for information purposes only and does not constitute independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or solicitation for the purpose of buying or selling of any financial instrument. All information is gathered from reputable sources, and any information containing indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment leverage product is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk, for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risks involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Please read the full risk disclosure on our website along with all the legal documentation that you might need. Good morning from South Africa. Jamie is saying, good morning, dear Jamie. So I guess you can hear me loud and clear. Okay, no one commented on that, so I guess everything is good. This webinar has been recorded like every single of our webinars, so don't worry if you don't have the time to stay here with us. You will receive the recording after we're done, the latest by tomorrow. Okay, if you haven't seen any email from us with the recording, please check the spam folder or the junk folder. Sometimes it goes straight there. Here is our email address, webinars@hfm.com. It's me, Stuart, and the support team that replied to that email, so feel free to ask anything you want. Nathanael, you cannot download it from here. I could do it with WeTransfer. Okay, let me try that right now. Is there a problem? Does this a problem with the GoToWebinar? You cannot find it or something? Let me know if you're struggling with the GoToWebinar. So where am I? Come on. No, because I connected my office PC and I can't. Oh, okay, no worries. I'm gonna send it. So will a WeTransfer help, or you are referring to an email? You prefer an email? Please, if you prefer an email, yes, okay. Okay, let me put a note, okay? Let me put a note. Okay. Okay. So, yeah, that's our email address, and I will move on. I will not reintroduce myself. I'm gonna go straight to harmonic patterns and what we're gonna cover today. So, a bit of introduction. We're gonna go through because harmonic patterns are some of them are based on price action, some of them are based on mean reversion. I'm gonna go through what is price action and what the mean reversion are, and what's the difference between those two before we actually check together what are the harmonic patterns, what they present, how they can be measured, how they could signal bullish or bearish signals, and etc. Okay, so we're gonna emphasize completely into harmonic patterns today. Is not something easy. I will clarify that right now. Okay, it's not something easy. It's not something that could be easily identified, but pattern is a pattern. So once you see something, it will be a powerful one. Okay, so okay, let me just put everything on the side, on the one side. Sorry. Okay, so let's start first of all with clarifying what the price action is. Okay, I think it's something straightforward, but because I'm not sure whether we have only intermediate traders over here, or also we have newbies, I'm gonna clarify it once again. Price action, as the name says, is the movement of the price solely without any indicators used. Is the movement of an asset price plotted over time. So clearly, if I put my screenshot, okay, I will get rid of all the indicators. Here's what we are calling price action. Solely the movement of an asset's price plotted over time. Okay, price action forms the basis of all technical analysis of a stock, of a currency pair, of a commodity, of energy, of any asset chart. So let's get back to our. So you know, you know, in the market there are a lot of kind of traders, right? Some of them rely solely on the price action, on actually checking their candles, checking the body of the candles, checking the tails of the candles without using any kind of indicators. If you are one of them, that's good for you. It's upon the character, it's upon the personality of each one of us on whether it would be a price action trader or a scalper or I don't know, a mini reversion trader, etc. So there are many different kinds of traders out there, and that's respectful. I mean that the decision is upon each one of us. Okay, there are a lot of traders, short-term ones, that exclusively rely on the price action and the formations and the trends that they see in order to make any trading decision, and that is totally acceptable. So now, what is so this is very briefly what is what is price action. Okay, mean reversion on the other side is something more common than price action. Okay, and it has to do with making a decision after an extreme price movement. So what I'm trying to say, mean reversion, okay, in the forex industry, in general in the markets, suggest, okay, that if sorry, I forgot to mute my mobile phone. So suggest that after, actually, okay, let me simplify. I don't want to read out loud this text. I want to show you the chart preferably. So so over here, let's do that. the theory suggests, and by investigating and going back the history of price action, the history of markets and etc., we have concluded over the years that the price of an asset always tends to return to the average level. Okay, so for example, dollar index is not a very good example, but just to give you an understanding, it has stuck since last Friday within this range, right? Theory suggests that regardless of where is currently, if it's on the upper side or if it's on the downside, it will eventually return in the mean, in the medium, in the average level, so in the mid of a range. This is what mean reversion suggests, that that the price tends to return to the average level, and extreme price moves are hard to be sustained for an extended period. So despite if we see an extreme bounce like this one, after every extreme move, the asset is likely to get back to the average price. That's why we are using, that's why the moving average are so important. That's why ranging indicators are so important. So for example, think about Bollinger's. Bollinger's presents us a range in which the asset is moving, and it has a middle line, which is the average level. So this suggests that always the price will eventually return to the midline. Okay, so this is a different type of strategy. The very first one, as I said, the price action. Solely rely on the trend. Trend is your friend. Monitor the candles, the body of the candles, the tail of the candles without any technical indicators. The second type of strategy is the mean reversion, when you rely on where you are taking decisions, trading decision based on the mean reversion trading, based on the fact that the price will eventually return to the average level. So the mean reversion traders have developed many methods for capitalizing this theory. So, but what you should stick on your head is that regardless of the method that each one of you guys as traders use, every extreme level, okay, which actually volatility was really high, we had a spike or a very strong drift of the price and etc., will eventually return to the average. Nothing goes up forever, nothing goes down forever, okay? We always need a correction, okay? Either with the use of volatility, either with the use of technical indicator in order to identify the average level. So that's the difference between those two. Now, very briefly, just I want to do this basic stuff in order to make sure that we are at least at the same all of you are on the same you have the same understanding, and just to be sure that we are on the same side. Ranging and trending, okay? Ranging, when the asset moves sideways, right? Stuck in a range, in a particular area. Example, current example is our dollar index and a lot of currency pairs today actually, okay? So stuck within 112.88 and 114.40 since Friday, okay? That's a range. Is when we don't have a trend, basically, is when the asset in a particular price, in a particular time frame, in this case is 1 hour chart for me, okay? So when there is a lack of trend and your asset is stuck in a particular area, this is what we call ranging. when we have identified support and resistance levels, when in which the price is touching them all the time, unable to break them. Yeah, this is what it is. Trending, when the market is trending, is when actually we have a clear trend, either to the upside or to the downside. So identify dips or throats in trend in order to get the best price during a trending market. Both markets could be traded by a different way though, okay? Ranging, for example, has a top area and a bottom area. So these territories are actually react as very strong support and resistance levels. And theory says that every time that the asset retests the bottom of the range, it could rebound, while every time that it reaches the top of the range, it could pull back down again. Okay, so now time to move on to our the topic of our webinar, and in order to explain also why I did all this introduction. So harmonic patterns. So give me a second. Okay, questions over here. Okay, perfect. Sorry. Okay, perfect. So, yeah, harmonic patterns. So either in a ranging market, either in a trending market, occasionally we find, we can spot that the price is forming some kind of a shape, okay? Some kind of a pattern, okay? So either that could look like a geometric shape. It could look like, I don't know, like yeah, it looks, most of the time it looks like a geometric shape. Okay, so this is what we're gonna go through today. We're gonna go through some patterns, the harmonic ones. Okay, I'm not sure how familiar you are with the candlestick patterns. There are plenty out there. Head and shoulders, wedges, cup and handle, rounding top, rounding bottom, and etc. These are not the ones that we're gonna cover today. What we're gonna cover today are a bit more advanced ones, the harmonic patterns. And so what we're gonna see is all this: A, B, C, D pattern, bat pattern, cuddly pattern, butterfly pattern, crab pattern, deep crab pattern, and shark. Okay, so they are a bit more advanced. I want to clarify that it's not easy to spot something like that, but if you see it, that is there. Don't try to find one. If you see it, it's there. If not, it's not. Okay, I don't want you to scan the market and say, today I learned all these patterns, I should try to find one. No, this is not how it works. If you see it, it's there. If not, then it's not. Okay, you need to be more, how can I say it, straightforward. Don't need to hunt. So what are harmonic patterns? They are, as I said, a type of complex patterns that we could find in the financial charts. They are based in geometric price action and Fibonacci levels. It's a combination of Fibonacci levels and geometric shapes. They have been introduced to the trading world by Harold McKinley Cantley in 1932. So you can find them in his book called Profits in the Stock Market. As I said, they are a bit complex, they're a bit more advanced patterns, okay? And yeah, we have spotted over the year, he has spotted over the year that each one of them mean something different, signal something different. And we're gonna go through them, okay? So he created, he spotted this pattern, he created this pattern, he outlined everything in his book, and each one of them means signals something else, signals bullish or bearish, and etc. So they are pretty much trading techniques. Okay, if actually when we properly identify a harmonic pattern, this allows us to enter a trade in a very high probability reversal zone with minimal risk. So harmonic trading techniques are actually utilize Fibonacci price patterns to how can I say, to quantify these relationships. So they offer a means to establish where the turning point will occur. Okay, so they are based on the Fibonacci theory. They are based on the Fibonacci extensions, retracement levels, and geometric structure. And as I said, they give you signals, they give you reversal zones, they give you potential support and potential profit and stop loss level as well. Okay, yeah. So they are they can be used as a trading strategy. What else I wanted to say? I think we're done for now. Let's move on because we're wasting our time, and let's start with the very first one. Anything you need, I'm here to help. Please interrupt me and ask your question. I will try to help as soon as possible. So the very, very first one, A, B, C, D. Okay. So actually the ones that I've put on in this webinar are is it 7? I put all 7 ones, right? 1, 2, 3, 4, 5, 6, 7. Yeah. All these 7 ones, the 7. There are others as well, okay? But these are the essential, the ones that every trader should know. Are the most essential, the most important ones. So we're gonna start with the A, B, C, D. Before I go through the ABCD, I would like to highlight that in general, the harmonic patterns, they have some very, very, very strict requirements. So if these requirements are not met, then you don't have a harmonic pattern. Okay? So you can see these numbers that I have on. These are Fibonacci levels. So if the pattern that I spotted doesn't meet these requirements, doesn't meet these Fibonacci levels, then it cannot be called as ABCD pattern. Okay. The ABC is a 3-leg pattern. So it is composed by 3 lines: A to B, 1 line; B to C, 2nd line; C to D, 3rd line. Okay, so some of them are composed by 3 legs, some are composed by 4 legs, some are composed by 5 legs. There is also one that is composed by 6 legs. So, okay, so yeah, and we're gonna go one by one. But all of them, all these legs, okay, all these lines are based on Fibonacci levels, on Fibonacci ratios. If not, then you don't have a harmonic pattern. I want to be clear about it, okay? And why I'm highlighting this? Because these Fibonacci extensions, these Fibonacci retracements create a potential reversal zone. So they point at, they will gonna help you to not only spot an entry, but also to identify your profit level and your stop loss. So if the pattern that you have spotted doesn't satisfy Fibonacci levels, then there is a big possibility to be wrong and to end up with a loss. Okay, so A, B, C, D is a three-leg, three movements if you prefer, pattern. It's one of the easiest of all. So you can see that. Let's do the very first one, okay? The very first movement is from A to B, a corrective movement from B to C, okay? And then another one from C to D, okay? And if you closely check, you can see that D, the final point, is below B, okay? And if you use your Fibonacci levels, use the Fibonacci tool from A to B, okay, you will see that the B to C, this correction, it could reach precisely 0.618 level. So, okay, I'm not sure whether I will be able to find an ABC formation in right now live, but what I'm trying to say is that do I have an example? Let me check. Let's try. Okay, A, B, C, D. So let's measure. Okay. That, can you see that this correction, it doesn't breach 0.61, the 61.8% Fibonacci. So we cannot claim that this is an ABCD formation. In order to be an ABCD formation, this correction over here, it should have touched the 61.8%. Is this clear? So I'm gonna get back to I. So yeah. Also, the CD line, this one, will be the same exact length as the AB. If these conditions are met, okay, then then you can place an entry, you can open a position, okay, close to the C point, which is defined as potential reversal zone, or you can wait until the entire pattern is completed before taking a long or short position from the D point. So you have two options if you spot something like that. Okay, one option, just give me a second. So as I was saying, you need to make sure that A and B, so B to C, it's the BC leg should reach precisely the 61.8% Fibonacci retracement on the A to B leg, and that the A and B and C D leg are equal. Okay, so there are two options. Okay, once, okay, you have seen this decline, right? A to B, and then you have seen this correction, and yet you have confirmed that this BC leg, okay, is breached the 61.8% Fibonacci level. Then what you can do, you can either enter on this level, on the C level, on the C level, a short position with target the D level. How you can calculate the D level? Just take the length of the AB and find and take this length and identify and subtract it from the C point, and you will identify the D point. Or another choice is to leave the pattern to be completed, so A, B, C, D, and once the pattern is completed, okay, if after D is completed, if the price goes up, then you can enter long, while if it goes down, you can enter a short position, okay? So there are two options. So just have in mind that AB, okay, ABCD pattern works in a slightly different way to any other patterns that you might know. In a bullish ABCD pattern, like this one, AB is a down leg, BC is a rebound, and CD is a down one. So in this case, once it's completed, once it breached D level, you should try to look. It's not easy, Christian. It's not easy at all. That's why I have another one. In the very next slide is an example, an old one in MT4, but it would be a waste of time to start searching for one, because as I said, you don't have to, you must not try to find one. If you see it, put your Fibonacci's on, check whether it meets the requirement. If yes, then check the rules and open a position. If you cannot see it, then it's not there. So as I was saying, yeah, a bullish ABCD pattern is the very first one. So you will need to wait until it's done, okay? Measure to make sure that AB and CD are equal. Make sure that BC is no way higher than the 61.8 Fibonacci level. And then you should start looking for a reversal higher. Once the D is done, you should look for a reversal higher. If you see a reversal higher, then you can open a long position. In the case that you have something like that, like the bottom one, this is a bearish ABCD pattern. Okay, again, the same requires are needed. A to C would be equal to B to D. Correction shouldn't be higher than 60.1% of the first leg. Okay, and once the pattern is completed, you should identify, you should wait for a reversal sign. Okay, you should identify for a pullback away from the D level downwards. This could, you could, in this case, you could open a short position, okay, with the stop loss above the recent high, so above D, okay, and target either C level or B level. So I'm going to show an example right now, okay? Just bear with me. I do understand that you have questions. I said from the very beginning, don't expect this webinar to be easy. It's are advanced patterns, okay? I will show you exactly now, Nicholas and Grace, how you can use this kind of, how you can open a position once you spot something like that. Grace, it can be applied in every single time frame. You might see this kind of formation in a daily chart. You might see it in 1 hour chart. You might see it in 30 minutes chart. It doesn't matter. If you see it in a 30 minutes chart, stick on the 30 minutes chart, measure, make sure that it meets your requirement, the Fibonacci levels, and etc., and take the position in a 30 minutes chart. If you see it in a daily chart, then you will take your decision and you will place your stop loss and profit based on the daily chart. So if you identify a pattern in a particular time frame, you need to make your risk management, your profit, your stop loss based on the time frame that you saw that pattern. Okay, you cannot go up and down and changing time frames. No, if you see a pattern in daily chart, you will take a position in a daily basis. If you see it in a monthly chart, you will take a long position in the long-term position based on the monthly chart. Okay, stick on what you see. So yeah, so this is an example for a gold. Okay, so we had an up leg, was moving higher, then a correction, it bottom up to here. So and then it moved up again. So what we did, and then we saw it that it topped over here. Okay, and then it started moving lower. So we measure A to B and we measure C to D to see whether they have the same length. Okay, and indeed they have the same length. A to B had the same length as C to D. Just to highlight at this point that they don't need to meet all the requirements, okay? So the very first leg and the third leg need to be the same, okay? If you have this requirement met, then you can, the second thing that you need to do is put a Fibonacci from A to B in order to measure C. So in this case, C didn't breach 61.8% of Fibonacci level. It breached 38.2%, which is fine, okay? Because we met the very first requirement. I mean, indeed, the AB and CD have the same length. Then, as long as B to C is between 38.2 and up to 61.8, then we are good, okay? Let me just, okay. For example, I said that it's not easy to find an example, but I will try. Not easy at all. Okay, let me try over here. So this leg is around 162. This leg, oh, it's way higher. No, it's not easy to spot one. Okay, this leg is 168, and this leg way higher. Okay, I cannot find a live example, guys, but this is what you should do. If you have spotted something, okay, put a line on. Put a line, okay. Leg 1, A to B. Leg 2, B to C. And leg 3, from C to the top. Okay, so I need to measure, is this line the same length as the CD one? So this is 165, is this is way longer, so we don't have an ABCD formation. But if this was the same length as this one, then the very next thing that you need to do is measure B to C. So you will put your Fibonacci, let's assume that you will put your Fibonacci in order to make sure that is somewhere between 38.2 and 60.1. So somewhere here. This is not, so we don't have an ABCD. Okay, I cannot find a live example right now, but just I want you to understand what steps you need to do. Okay, is it clear so far? Wait, Christian, wait. I haven't discussed yet about stop loss and profit. I want to make sure that you do understand the steps in order to identify, first of all, to confirm an A, B, C, and D formation. Okay, so the steps are these. The ones that we said. Make sure that A, B, and C, D have the same length. If they have, measure, put the Fibonacci from A to B in order to check that this leg is between 38.2 up to 61.8, maximum 88.6. That's flexible. It's a bit flexible, this condition. So, like in this example, we did our homework. We saw that it has the same length. We saw that it's 38.2. That's sufficient. So what we need to do next? Once we measure, we need to take a decision monitoring the D territory. So after D was breached, the asset started sloping down. Oops. Sorry. So then what you can do is use a Fibonacci from from D to C. So this Fibonacci that you hear over here is from D to C. So like that. I'm gonna get rid of the initial Fibonacci, and I'm gonna put one from D to C. Okay, and the target. Sorry, I put it vice versa. Oops. Here we are. Perfect. So, like that, this is how you're gonna do it. Okay. So, if your asset started turning down away from D, then you can enter a short position, okay, with the target either the 50% retracement level or the 61.8 retracement level, okay? These two could be your profit levels. Stop loss could be either at the top of either at the D or slightly above it. Is this clear? Stop loss should be, in this case, in this example, either at D or slightly above it. And profit taking will be 50% or 61.8%. If the 61.8% it breaks, then it could breach as low as C level. So if it breaks, then you can either add to your current position and set a new target at C level, or you can open a new one. So that's up to you. You're welcome, Christian. I highlight, guys, I know that it might be a bit complicated for some. It's because it's a bit of an advanced webinar, okay? So it needs a lot of homework from your side. It needs to go sit down, see the slides again and again, maybe Google a bit, each pattern, see a lot of examples, okay? Yeah, I'm afraid that's it. It needs time from you to see them. Okay, Bruel is not here. I'm gonna, okay. So, another one. Just before I move on to the next pattern. So this example was a bearish example, okay? A bullish example looks like that. So from A to B, so a down leg, an up leg, and another down leg. So if on D we see the asset started rebounding, that would be a long position, okay? I managed to find only a bearish example. So, and okay, I didn't make it clear, but don't worry about C level. C is a bit flexible, so it could be from 38.2 to 88.6 maximum, but as long as A and B to C are equal. This is standard, okay? This is, you need to make sure that these two legs are equal. If not, you don't have an ABCD formation, okay? Okay. Bat pattern. Do you know what the animal, the bat, the one that was supposed to be responsible for COVID? So, okay. Not a really bad combination, but never mind. Okay, yeah, but looks like a but is when your price action does this M, the letter M formation. It looks like a but. Okay, so this is a pattern, and actually it could be the retracement and a continuation pattern. It could be both. It's a very powerful pattern if spotted, but it's not easy to spot something like that, okay? But if you do, it's a very powerful pattern. And it's actually quite new. It has been discovered in 2001. Okay? So it's a retracement and a continuation pattern. It forms when a trend temporarily reverses direction and then continues on the original course. Okay, you see, so our trend was up, it did a bit of a correction, it came back down nearly, just slightly above the beginning of the trend, and then started to move up again. So it's when the formation does some maneuvers before it continues on the original course. The same stands for a bearish bat. Down, did a bit of an up and down and up again, just slightly below the original price, and then started going down again. So this is a four legs formation. 4 legs, 1, 2, 3, 4 legs formation, and is a retracement and continuation pattern. Yes, pattern. So what is necessary in this formation? It is necessary that the D level, so the final level, okay, is not at the same distance as, is not at the same level as the original the beginning of the pattern. In a bullish path, the D is slightly above the beginning. And in a bearish pattern, the D is slightly below the beginning of the trend. Just a second. Yeah, so it is, in this, Fibonacci measures are necessary for every point within the structure, and it is necessary to note that D is not a point, but rather a zone in which price is probably going to reverse, either rebound if we're in a bullish pattern, or put back down if we're in a bearish pattern. So this is a zone also known as the potential reversal zone. So it has one leg more, if you notice, from the ABCD pattern. So it's a 4-leg pattern. So the very first leg is called XA. So from X goes to A and leads to A, and leads and will eventually lead to a retracement from A to B and a B to C. If the retracement up to point B stops at 50% of the initial XA movement, so once it comes down, okay, we had an up leg from X to A is an up leg. Then we have a correction up to point B. If B stops at 50% of this XA leg, then we are probably looking for a bad pattern. If B is below 50%, then we don't have a bad pattern, so you need to forget it. Now, if it goes as if B is the maximum at 50%, then you are looking for a bad pattern. So then you need to monitor whether the B to C, okay, B to C, when we have a rebound, and then the C to D extension must be at the least a 1.61% Fibonacci extension of the BC leg. Okay, so the CD, it will be bigger than BC, okay, but no bigger than 2.6% Fibonacci extension. Okay, another way to, okay, so I will show how exactly, but before I show, I want you to follow me a bit. So let's assume that we have seen this up leg, we have seen this correction at AB, we have measured that AB is no bigger than 50%, then we had a rebound, okay, and then another leg down, and we have measured this leg down, and we saw that is somewhere between 1.61 or the maximum 2.618 of the BC leg. Okay, if we have check all this, then the CD extension, a bullish body is verified, and the D creates a potential reversal zone. So what that means? It means that you can open a long position, okay, with target either the B level or the C level. Okay, this is in case that we have a bullish bat. In a bearish bat, then it will be a short position. Okay, so I will let me move on quickly to an example, because I want you to understand. Okay, it's difficult, I know, but it is what it is. This is a bat formation. Why? We have a leg, okay, X to A, fair enough. Then we saw a bit of a correction, okay. Then we saw another rebound, and then we saw that it's turning back down again. So we need to measure. So what you need to do? You need to put a Fibonacci level. First of all, you need to put a Fibonacci from X to A. Why is that? Because you need to make sure that A to B is not bigger than 50% of this leg. So it should be somewhere between 38.2 and 50% of the XA leg. If that's the case, then tick, one tick. So one confirmation. Then the next step is so requirement number 1, A and B, A to B should be somewhere between 38.2 and the maximum 50% of first leg. Okay, that's one thing down. Second thing down, second thing that you need to check is the movement, the BC movement, that you have a rebound that shows this BC movement, and that BC and that C, it is below A. So this leg, the BC leg, should be between 13.2 to 88.6 of AB wave. So where can I find a live example? Can I? Oh, let's see. Okay, let me get rid of that. Okay. Okay, let's see. Leg number 1, leg number 2, leg number 3, and leg number 4. Okay, let's measure. This is X to A. Let's measure. Okay, so you see B, A, so X to A to B. The A to B, it break the 50%, so we don't have a bat. Okay, we don't have a bat, unfortunately. So I need to find another example then. Oh God, that's why I said it's not easy to find one, my dear. My dear Christian. We will be able to find one, yes or no? Not easy. That's why I said, if you see it, is there. If not, don't waste your time to find one. No. This could work. So we have one leg over here, up. Okay. A, let me zoom in over here. Okay. One leg. So it's X to A to B. So A to B reach 38.2. Okay, let me be precise. I need to put the Fibonacci exactly on the price action. Okay. Then B to C. Okay, so B to C. Now I need to measure B to C. So I need to put my Fibonacci again from A to B over here. Sorry, vice versa. So, oops. Here to here. I need to make sure. Put it vice versa again. And I need to add the 88.6 Fibonacci level as well. Fibo at 0.886, 88.6. Okay, so no, it break it, you see? It was nearly, it was more than 88.6, so it doesn't meet our requirement. Guys, I cannot spot a bat right now in order to show you live, but you need to understand how to do it, okay? Hopefully you did. Is it possible to re-watch the webinar? Yes, of course, you're gonna receive a recording. Can I open the long position on reversal point or looking to find a setup? Like, no, you don't need Dolios, Nathaniel, no, you don't need to. As long as you check A and B, in order A and B to be between 38.2 and 50% retracement level, B to C to be maximum 88.6 of the AB leg, and then you have seen from C the asset turning lower, breaking B level, you can open a short position. So as soon as the C starts moving down and you see it breaking B, okay, moving below B, so over here, you can enter a short position, okay, and with target the maximum 2.61% Fibonacci extension from C to D, from 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 A to B. So you need to put your Fibonacci extension from A to B, and the target will be maximum 2.61. So if I go back, try to find something for you. Okay, that wasn't great, but I will demonstrate here, okay? So where is it? I lost it. Oh God. And I lost it. Okay, perfect. No, 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 no. Let me check that one. Okay, this is okay. Okay. X to A to B, 38.2, that's good. Then we are adding A to B. We saw that the asset, no, that's not correct. That's not the bad. I cannot find the bad, guys. But what you should do is put your Fibonacci extension, okay, from A to B, okay, and as soon as you see the B broken, you can enter short with target at 161 or up to 261. This is way far away, so you should probably use 161 as your very first target. Okay, here I cannot show you that because it's not a bad formation. Okay, but if you show bad formation, you can enter here short with target between 161 Fibonacci extension up to 261 Fibonacci extension, okay? Or you can wait until this final leg is done, is completed, okay? Once this is completed, once this is done, measure again, make sure that A and B is maximum 50% of XA, B to C is maximum 88.6 of A and B, C and D is maximum 261.8% of BC. And if that's the case, then you can open a long position with initial target B and second target C, okay? Is it clear? You see, this is another example in which the CD wasn't 261.8 Fibonacci, it was 161. So as long as your CD is somewhere between 168 and 261, then you can open a long position with the very first target A and second target C. If that breaks, you can add D as well in the equation. In a bearish formation, the bad pattern is like a W, but the same exact rules, requirements are necessary. You need to measure A and B, you need to measure BC, okay? And if on the C you see a rebound higher, you can open a long position with very first target the B, and second target the extension, the 168.2% Fibonacci extension of B to C, or up to 261.8 Fibonacci extension. Or you need to wait until all this is completed and open a short position at D with target B and C. I haven't used a Fibonacci tool before. Does it need some? Oh dear, Dominic. Then if you haven't used it before, then don't try all this that we're saying. Make yourself familiar with Fibonacci tool and Fibonacci extension, because Fibonacci tool is not just a single tool. We have Fibonacci extension, we have Fibonacci triangle, we have Fibonacci retracement, we have Fibonacci extension as well. So I want you to get familiar with the Fibonacci tool in general before trying something like that, okay? Because otherwise it's like you need the basics. If you don't know the Fibonacci tool and you have an expertise on that, this will get even more complicated and might lead to false decisions. Okay, Dominic? So I would like you to take a step backwards, watch a webinar in Fibonacci, for Fibonacci, and then once you feel very, very, very confident about it, then try to learn the patterns. So I'm getting back to Nathanael. Nathanael, a head and shoulder is when so a head and shoulder looks like that. Let me draw. Head, shoulder number 1, head, shoulder number 2, in which we have very similar neckline over here, and the shoulders are somewhere in the same area, not far apart. So this has nothing to do with head and shoulders. This is very, very different. You see, this looks like that. So the second peak is below the first peak, right? So both of them are suggest that the last leg is down, but in head and shoulder, it doesn't mean that it will go up again. While in the bat formation suggests that once the last leg is finished, then it will go up. Okay, so you don't confuse, don't compare the one with the other. Two different things. So as you can see over here, I was waiting for the D to finish before taking a decision. So as soon D finished, okay, I had my lines on just to remember that I have spotted the bat. So I was literally waiting, waiting for a bullish sign. So bullish sign came with this big, actually, we don't need a bullish sign because it's completed. So we could say that we could use our Fibonacci level, as we said, right? From C to D. And we can open a long position with target areas 61.8 or even the C. We said the B or even the C. Okay? That's it. And it did. You can see it took some time, but eventually it breached the B level, or otherwise the 61.8%, and eventually it get as high as C. So that could be your potential profit target areas. Stop loss, slightly big. X could be used as stop loss, by the way, or do your risk management and put your stop loss slightly below D. Or you can wait, or you can use trailing stop loss, okay, as well. So how to trade when you see the bad pattern. Okay, we went through it. We covered all this, but first of all, draw the pattern, right? Measure your legs. Measure XA leg, measure AB leg, measure BC leg to make sure that meets the requirements, okay? And finally, measure CD leg, okay? You need to make sure that some of these requirements are met. You need to check the impulsive leg or the XA leg. You need to identify whether it's a strong move up or a down, depending on whether we are in a bullish path or bearish path. You need to make sure that XA, AB is somewhere between 38.2 and the maximum 50% of your XA leg. You need to measure also BC. BC shouldn't be greater than 88.6% of the BC formation. You need to make sure that CD is no longer, let me take a step backwards, is no longer than, is no bigger than, come on, is no bigger than, is somewhere between 168% and 261% of BC. So you need to meet, they need to meet these requirements, okay? So another formation. Okay, Nathanael is asking something. I mean, after the completed D on a bad pattern, it could looking for a setup of for long position or not. Wait. If you have a complete, if the pattern has been completed, right? If the pattern is completed and you have checked the requirements and they are met, right? Then you know the direction. If you had this formation, then you will enter long. If you had an inverse bat, so like looking like a W, then you can go short. Do you get what I mean, Nathanael? So if you have seen this like a W and you checked with the Fibonacci levels that all these conditions are met, then at D, you can open a position. Just make sure that your stop loss is just below the D or even somewhere below X, just to make sure that it won't be stopped out sooner than expected. If it's an inverse bat, as soon as this completed, and by saying this completed is when you start seeing some consolidation or a bit of a reversal, etc. Then you can open a short position with target here, right? The B and C, and stop loss either slightly above D or slightly above X. So you know the direction once all the criteria are met. Okay, so let's make it more complicated. Cartley pattern. So they're very, very similar. It's very, very similar to BAT. Okay, so we have a lot of numbers out there, I know, but you can put it in a table, okay, because they're very, very similar. So it looks like a bat, but it has some slightly different requirements. That's why sometimes when we're looking for a bat, it ends up to be a Cartley. So it's not a waste of time, to be honest. Okay, so sometimes it ends up, so in the case, I didn't save the examples that were working earlier, because the very first that we saw wasn't a bad, but it ended up to be a Cartley apparently. Let me see if I can find it again. Will I be able to find it again? If you find one yourself, let me know, guys, okay? Just to demonstrate. Like 50%. Okay. Oh God, I should have saved that earlier. We found a nice Cartley and I forgot to save it. Nevertheless. So Cartley is very, very similar with BAT, but it has slightly different requirements, okay? Slightly different requirements. So in this case, the AB could be up to 61.8 Fibonacci level. Remember, BAT is between 38.2 up to 50%. A Cartley pattern, it could be as high as 61.8. So if you spot a BAT initially, but when you measure it, it ends up to be a Cartley, that's fine. No, it doesn't look like A, B, C, D. It looks like a BAT, but with longer AB lines and BC lines. Isn't it, dear Bruel? ABCD is a three legs formation. BAT and Cartley are four legs formation. So in this case, the requirements are a bit different. It's okay if A to B, it breach 61.8, but no bigger than that. And also, okay, this is the same requirement with the BAT. Remember, in the BAT, come on, in the BAT, BC should be up to the maximum 88.6 of A and B. So this is the same condition as Cartley. So BC could be the maximum 88.6% of A and B. So somewhere between 38.2 to 88.6. Why am I drawing it? It's over here. So B to C could be somewhere between 13.2 to 88.6 of ABC. But the final leg, CD, should be from 113 to the maximum 1.61% of BC. While in the BAT formation, it could be from 161 up to 268, remember? So in the Cartley pattern, the maximum length of CD should be 1.61% Fibonacci extension of BC. So you see, sometimes we initially thought that is a BAT, but we end up to be a Cartley, or we thought that it would be a Cartley and we end up being a BAT. So it's not a waste of time, because it might be one of the two. So that's why it's good to put some notes down and say, okay, A to B is that length. Then until B to C is completed, measure B to C. And then once CD is completed, put a note down in order to identify whether it's a BAT or a Cartley. And the same mentality stands as soon as the pattern is completed at the D level, you can open a long position. If it's a bearish Cartley harmonic pattern at the D level, you can open a sell position. So if it's a bullish Cartley position, a long position can be taken with targets at C and D and stop losses just slightly below D. Okay, the same stands for bearish formation. A short position will be taken with target at C or even A. And stop loss slightly be above D or at X. So let's see an example. A very old one, but it was the best I could find. So here it is. I had the X and A. I measure A and B. It was 62.65, so it was slightly above my 61.8%, but I put a note on. Then it rebounded, right? So it met the 86.8% Fibonacci level. So that's also done. That's good. Met both requirements. So in this case, as soon as I see the asset turning down, I could open a short position with the very first target at B, or I could wait for D to be completed. And as soon as D is completed, okay, I could wait until I need to make sure that it won't be drifted further down. I need to see it either consolidating or rebounded before entering a long position with target at C and either A or even higher. So your target could be as high. Let me take a step backwards. Have I put over here? No, we haven't mentioned it. Your target could be as high as 100.27 Fibonacci extension. But over here, Nathaniel, because you keep asking, guys, when I say that the pattern is completed, okay, you need to wait until D stops dropping and is either consolidating or it has consecutive bullish candles. If it has consecutive bullish candles, then it means that the rebound started. So it gives you confidence. That is the rebound of this started. If you don't see that, then wait, okay? Because there is a long way until target 1 and target 2. So it's okay to be a bit late, okay? Just to make sure that D has found a floor and there is no further decline. Because if there is further decline, then we don't have a Cartley. Because remember, D needs to be above X. Okay, so another example of Cartley, but this time a bearish one. X, A, B, I measure B was slightly below 61.8 Fibonacci level. That's cool. B to C, I measure B to C. B to C was somewhere between 60. So you remember B to C, it could be somewhere between 38 and up to 88.6% of AB. So in this example, it was at 61. So we are within the appropriate levels. That's okay. Then you can, as soon as you see bullish candles, you can either take a long position with target B or up to 1.61% of BC formation, or you can wait until D is done, okay? And as soon as you see bearish candles, consecutive bearish candles, so that means a short position could be taken with first target at C level, okay, up to 127%, okay? Where is it? I remind you my requirements, my targets, okay? So CD, if you want to open a position as soon as C is formed. So you can open a long position with target either B or as high as 1.61% of BC formation. If you want to see, if you want to the asset to be completed, the pattern to be completed, then you need to wait until D is completed and until you start seeing a pullback away from D. As soon as you see bearish candle away from D, then a target can be placed either at C or up to 88% Fibonacci level of BC formation. So you see I have it here. So where is D? D in this case is 78.6. So if you have entered a short position at C, you could use 61% as your target, as your very first target. If you wanted the asset to the pattern to be completed, you could wait until D founds a floor, consolidate or post a rebound, bullish consecutive candles with targets initially the C level, and if the C level is broken, then it could be as high as 167 or up to 161% of XA leg. Is that clear? Let's go to the butterfly. Oh my God, it's already an hour and a half. Butterfly, very, very similar with the other two that we have saw, with an exception. The D is below the initial level, below X. Okay, so if you thought that it was a battle, but it failed. If you thought that but it failed. If you thought that was a cattle, but it failed, it might be a butterfly. So if you had this M or W formation with the D below X in a bullish pattern, or the D above X in a bearish pattern, so it might be a butterfly. So what you need to check, you need to measure A to B. A to B can retrace up to 78.6% of XA leg. B to C could be somewhere between 38.2 or and a maximum 88.6 of AB. And CD it needs to be the longest leg. It will be bigger than X and A, but not bigger than 2.61% of AB. No longer than that. And if it's up to here, then you can open a long position. Otherwise, you can, if it's a bearish butterfly, you can open a short position with targets at the bottom of the pattern, okay? So that means at A level. A lot of rules. It's not easy. You need to create a table, put all the requirements on in order for you to be easier to identify this kind of patterns. So this is a bearish pattern. XA, AB, AB was 88.6% of XA, BC was 70%, 75% of A to B. And so here we can open a long position with initial target at B. If you weren't sure about something like that, then you could wait until D is finished. So as you can see, D topped over here and then started consecutive bearish candles. So by measuring C to D, we saw that is 1.23%. So it's still meeting our requirements, because the maximum that CD could be is 1.61%, the maximum. So it met the requirements. So as soon as you see 2 or even 3 consecutive bearish candles at D, we can open a short position with target at C or up to A. Okay, C and A. Oh, and so an even more complicated one. I think I'm gonna cover them like quickly because carb, D, crab is when D is way, way, way far away from X. So, okay. A and B, again, up to 61.8% of XA. B and C, up to 88.6 of AB. And C is way higher. So C is breaking B, is breaking X, and is nearly double than XA. So it could be as high as 161% of XA. So if D is as high, maximum 61% of XA level, then you can, if you see a bearish crab, you can enter short with targets at C and A. If you have a bullish crab, you can open a long position with targets at A or C. Okay. Last but not least, a deep crab is in the case that you see the it's in the case that CD could breach 2 up to 3.6% of BC. Can you see that? This is the difference over here. This is the difference, okay? 3.61 up to 3 points, so more than 3 times bigger than BC formation. So you could either enter. So if we have a bullish dip grab, you can open a short position once B is broken and target 2.61% or even up to 3.6% of BC. If you are in a bearish dip crab, as soon as you see B broken, you can open a long position with targets 2.6% or even 3.6% of BC. Or you can wait until the pattern is completed and then open another position, okay? Sorry guys, it's a lot of information. It's not easy. You need to comprehend. You need to comprehend them. You need to study them. You need to. It would be more convenient if you have a table. We have still sharp. I'm not gonna cover it today. It's getting even more complicated. I have all the information in the slide. But what I want you to do, if you are interested in harmonic patterns, is do a table. Do a table in an Excel file, okay? And write down A, B, C, B, C, and D, crab, bat, okay, shark, etc. And put the requirements. So X, A, B, B, C, C, D, okay? So for example, A, B, C, D, so, okay, no, not, so in a crab, so A, B needs to be, so in a bat, A to B needs to be from 38.2 up to 50% of AB in of XA. In a crab, this should be the maximum 61.8%. Okay, I want to pass in an Excel file all the requirements. So print it or have it in your PC and etc. And every time that you think that is something, it might be a harmonic pattern. You need to check your spread and say, okay, I measure it. Is the A and B is up to 50%. So put a tick over here. Then you need to wait from BC to, if you have a tick, if indeed is meeting the requirement of that, but then another tick here, and then with this way it will be easier for you to spot whether you have a crab, whether you have a bat, whether you have a cartilage, whether you have a shark, and so on and so forth, because all the requirements will be in a Excel file, and you will only need to tick everything you see in order to spot which pattern it is. So with this way, it will be easier for you to make a decision to spot which pattern it is and to enter a position. Okay? Yes, guys, I'm gonna give you the I have the handout in the handout section, but I will email it to you as well. Okay? Yeah. So actually, it's better if you send me an email that you need the PDF, because there are many, you are too many, and cannot do it one by one. So it would be easier for me, guys, to send me an email at webinars@hfm.com. Okay, and ask me, Andrea, I want the email, I want the PDF. Okay, it would be way easier for me, because you are too many and I need to manually find your email addresses and etc. Okay, I'm gonna call it a day. Thank you very much for attending. It was an advanced webinar. I do understand you if you are confused. I will be here for anything you need. Don't hesitate to contact me. Provide me screenshots, provide me your questions, and I will help you as much as I can. Okay? Thank you very much. Thank you. Bye-bye.